What we're going to do at the moment is sort of change our focus a little bit. We've spent the morning discussing some of the macro issues, some of the issues facing the stock exchange, and as we've just heard, some of the governance issues and other policy issues relating to listed companies. There will be some themes that we'll sort of address in this session. But this session for the next 60 minutes is essentially about the supervisory approaches, the challenges and the risks that are facing market intermediaries. And this is when we're dealing with stockbrokers, we're dealing with asset management companies, CRAs, and the intermediaries and licensed corporations, banks and registered institutions in Hong Kong. And I'm very pleased to have with me at the panel today, from my far right, Andrew Proctor, who joins us from Herbert Smith. But Andrew brings a wealth of experience being a former regulator and also a former head of global compliance for a leading financial institution. Raymond Chan joins us from the HKMA. He will be in a couple of days the Executive Director of Banking Supervision. Sophia Leung, who's Chief Information Officer for JP Morgan in Asia Pacific, is going to be our specialist expert on some of the cyber and technology risks, which I'm sure all of you will agree are one of the foremost challenges for all of us in the room. And Stephen Poe, my colleague from the SFC, who is Senior Director and in charge of Intermediary Supervision. As I said, we're going to be looking forward-looking about some of the risk challenges and responses when it comes to market intermediaries. But what I also wanted to start the conversation by saying is that there's still a long way to go to get market intermediaries, both from a conduct, control, and a cultural perspective, to the place that we need them to be. And I say that because in the 3 years that I've been at the Commission, we've had studies, we've had surveys, we've had inspections, and it all indicates to me some of the starting premise that I had coming from the industry was that there's still a lot of work to be done and more responsibility to be taken. We're going to do this by trying to cut through the rhetoric and get to some of the reality, because there's a lot of rhetoric out there, there's a lot of responses, but there isn't necessarily some of the real response and real action to be taken. As I've mentioned, we're going to have a conversation about some of the particular risks, particularly cyber and anti-money laundering, but I wanted to start philosophically. And now that we know that Andrew Proctor is the founding father of the 3 guiding principles of the SFO, I wanted to ask you, Andrew, to just sort of set the scene. How can a licensed corporation or a bank think about the challenges, future-proof from a risk perspective and a regulatory perspective?
Well, thanks, James. It's a big question, and I think, let me start by saying that it's not going to be solved by doubling the size of the regulatory rule book. To pick up on your observation about culture, I think that will be a key component, although there I see a problem in the way people talk about culture. Both regulators, actually, and chief executives within banks and financial institutions tend to talk about culture as though it were one single monolithic characteristic of an entity. In fact, most of the problems that have arisen in the last few years have arisen because of subcultures. And drilling down and identifying where those risky subcultures are emerging in an organization actually is the greater challenge. Of course, and by all means, try to establish a culture across an organization, but understand that within that there will be pockets of subculture that need to be identified and addressed. The biggest investigations of the last few years have thrown up the observation that banks and financial institutions didn't really understand a lot of the risks that they faced, even though an enormous amount of work was being done within those organizations to try to understand those risks. You had risk maps from the compliance department, the audit department, operational risk, and others, not very well coordinated, arriving at slightly different conclusions, but still managing to miss, despite all of that work, some of the key risks that crystallized. In fact, they tended to be produced by those different departments, shown to the front office who'd say, yeah, fine, get on with it, and not really the product of a cross-divisional and 3 lines of defense approach and identification of the risk issues. Despite all the rhetoric, everyone said they had a 3 lines of defense strategy. In reality, they didn't. The other thing that's emerged from those big investigations is that it was only really when you sat and thought about risks, not having thought first about what risks might I expect to see, but looked at it in terms of activities, and engaged with the front office, the IT department, compliance department, and all of the other parts of the bank, finance, etc., and thought about those activities in a lot of detail, that people really understood what was happening within the organizations, and they could really start to unpick and identify risks, and then start to think about the appropriate mitigation strategies. And then finally, just by way of opening observation, the other common characteristic that you see coming out of those large investigations is that although banks and financial institutions had always said that they had a lessons learned approach to things, in reality they didn't, or it wasn't very effective, or it didn't happen until too late. And so when a problem emerged, when a risk crystallized, if you like, the tendency was to circle the wagons, defend the bank, protect privilege, deal with the regulators, and then think about what lessons might be learned, but only to think about it in the narrow context of the risk that had emerged. Now, a lot of the better banks now are rethinking that question or that approach, and they're saying, right from the start, we need to be thinking not only about this crystallized risk, but we need to be asking, where else might it occur? Where are there similar things that we need to address? And that also forces you to change the way you undertake your own internal investigations. Maybe in some cases sacrifice the lawyer-led approach to internal investigations. So I see a lot of the banks in particular who are rethinking that whole question of internal investigation. And finally, the supervision and the role of the senior managers and the way in which that is being reshaped by initiatives like the senior managers regime loops us back to the start and the cultural question, because that cultural initiative, that looking for identification of the subcultures that are problematic and trying to build that single uniform culture really starts with the senior managers.
Yes, that's right. We're going to come back to the senior management responsibility in a minute, but I just wanted to pick up on a couple of your points about the sort of the static responses, and I think that's right. There is a static response to an investigation. There is a static response to an issue, as opposed to an ongoing, holistic, perennial challenge and a perennial mindset. And that, in my observation at least, is part of the challenge. But Stephen, would you add on my comments or Andrew's?
Yes, probably I will mention some of my personal observation on these issues. I see that there are three challenges to the industries in the years to come. The first one would be on the incentive. Second, technology. Third, risk management. Let me try to elaborate on my personal thought. Picking up what Andrew Chan mentioned in the first panel about the term financial engineering. Then let me pose a question to you. Financial engineer basically do a great job in structuring a lot of complex financial products like CDOs, which is a very difficult task. But compared to a civil engineer who build a toll, who build a road, to build a bridge. And the fundamental question is why a financial engineer can earn so much as compared to a civil engineer who are doing equally complex and difficult tasks. So if the industry can never get the incentive scheme right to make a right balance between the risk and reward, then the sort of the things that Andrew Proctor mentioned earlier, the cultures will never go away, will still come back to haunt the industry in the years to come. So this is the first point on the incentive. Second point is about the technology. Everyone always thinks that we run on the world of technology neutral. But the last changes of the technologies in the last 20 years really changed a lot. Think about those acronyms that we are now using it every day that have never been used before. Algo trading, dark pool, high-frequency trading, and crowdfunding, P2P platforms, and also the latest, the robo-advice. All these linked to the use of the technologies, the web, the internet. Basically, the change of the technology changed the whole industry, provide their services to their customers, and to a certain extent shaped the regulation, a fact about how we assess the risk of the firm. And that naturally brings me to the third part, is about the risk manager. In the first panel, we talk about the role of Hong Kong as a risk manager of China, of those people or intermediaries using Hong Kong to manage or hedge the risk in investing in China. When I and my colleague talk to a number of the firms here, many of you sitting here in this room, most of your risk managers comfort us as regulators that you have been monitoring, assessing, and mitigating all the risk, on 99% of the risk. That we fully understand. And very honestly, from my perspective, I don't have any concern or doubt on that 99% of risk well managed by you. But my question is always on, how about that 1% risk that's never been shown on your VAR figures? And 1% of the tail risk, what to do about it? So at the end of the day, in order for us, for the industry to be vibrant, to make contribution, how the industry in total to manage those 1% unexpected backswarm event risk is fundamental for the industry to get to the second level.
Since you're being philosophical, I'd also try and pass on or pick up on some of the philosophy from the last session. And K.S. Lowe mentioned the report by John Kay to, I think, the FCA and also the Parliamentary Standards Committee in the UK. I'd recommend, when we're talking about the challenge, the cultural challenge, the holistic challenge, and the philosophical challenge, that all of us in the financial services sector, I would recommend his book, John Kay's book, Other People's Money. I think that's a very challenging and thought-provoking book. And it also picks up on Andrew Sheng's point, which is a very important one, which is the multiplication and the financialization of the financial services sector. And we need to ask ourselves the question, what role, economic and societal, are we serving? And as John Kay was saying, are we getting into casino territory? But just whilst we're also channeling Andrew Sheng a moment, going back to Andrew Proctor, Andrew said that it's too complex, the regulatory response. It's too complicated and it's micromanaging. And I just wanted to get your observations on that before I ask some further questions.
There are parts of it that are too complex. There are parts of it that are over-engineered. But actually, what's astonishing about the senior managers regime introduction in the UK is how simple it is. You have a job description that's up to date, have organisation charts that are up to date, produce a map that puts it all together, and people are freaking out. Right? There are people who've got job descriptions that they looked at when they joined. They don't look at them again until they want to leave because they need to know their notice period. And in the meantime, they've done 101 different things. The org charts are full of dotted lines and sometimes deliberate ambiguity within a matrix structure. People have titles that are glorious. I'm the global head of something. And then when you tell them that that's going to make them part of the UK regulatory regime, they say, I can live without that. It's very, very simple. And you don't, nobody, and actually I've sat with dozens of senior executives now and talked this through, and I begin every single discussion by saying, I don't think I'm going to tell you anything that will surprise you. And so far, no one's been surprised. But they've always gone away and thought, boy, I really need to get things in order here. My management information is just a data dump. I've got people who are not clear in terms of my expectations of them. I don't know what I'm getting back. I can't explain how I'm dependent upon other parts of the organization. If I'm a subsidiary based in the UK, and it'll be the same if you're a subsidiary based in Hong Kong, it isn't clear where the global and the local begins and ends, even though, frankly, that's not an advert for onshore decision-making. Onshore responsibility is another matter. But working out how it all fits together and then being able to argue and demonstrate to a regulator that actually the global approach may be the better approach, that's fine. They couldn't do it. And then last of all, when you explain to them that they may have to show all of these things that they've done and these reasonable steps they've taken 2 or 3 or 4 years later, they say, I couldn't do that. Things are all over the place. There are no records. There's no ability to demonstrate what it is they do. Now, that's their problem in a sense. That's an evidentiary issue. But what it's also thrown up is the very simple observation that they just don't track things. Then they have a meeting with one of their direct reports. The direct report's sent off with a list of things to do, not necessarily followed up. Maybe they are, maybe they're not. Depends on the memory of the person who's asking the questions. None of that's at all complex. You can point to detailed rule books and the like, and there are some things in it that probably go over the top in terms of engineering. But the simple things are not in place.
But what about the regulatory response? Is it too complex? I mean, it's obviously great news for you lawyers, but do you think that there's actually a demonstrable change in the years that you've been looking at this? And I think that's a really interesting question, because are we trying to rule our way out of this mess, or are we going to try and have holistic cultural solutions, or what is the way?
I think there's an each way bet at the moment. You know, there's a sense in which, on the cultural side, the regulators are like the kids sitting in the back of the car saying, are we there yet? Are we there yet? But nobody knows where they're going. And actually, that tends to simplify the question. It takes me back to where I began in terms of this concept of one single culture, which typically doesn't exist. But on the other hand, it is right to keep asking of senior management within organizations, what are you doing? How are you thinking about it? How are you working through the progress along the journey, even if you're not quite sure where it's ultimately headed or how long it's going to take to get there? That's a reasonable thing to do. So there is that part of it, which I think is fine, and the simple aspects of the senior managers regime are fine. Yes, as a regime, it's overcomplicated, and reading the thousands of pages, literally thousands of pages of consultation and handbook is a nightmare.
We'll come back to senior management responsibility, but I'm going to channel, again, your former life when you say the regulators don't know where they're going. Actually, Keith's enunciation earlier was great. I mean, those general principles about the safety and soundness, systemic risk, investor protection are really important to remind us. But that's probably a good segue for Raymond, you know, to pick up Andrew's question. Are we there yet? What's your observation of where we are in the last couple of years?
Well, from my point of view, I don't think we are there yet. I think more needs to be done in relation to, promoting proper corporate culture. I don't know the situation in the securities sector, but in the banking sector, I think we certainly need to be doing more. The subject of today's panel discussion is how to be a future-proofing intermediary. I just want to highlight one business trend that is happening in the banking sector. And I believe a similar trend is also observed in the securities and insurance sector, which is that financial firms nowadays are selling more and more financial products to overseas customers, particularly those from the mainland. I think this presents two challenges for financial firms in Hong Kong. One is how to make sure that the right financial products are sold to these overseas customers. In other words, how to keep the mis-selling risk to a minimum. The other one is how to make sure that sufficient information is gathered from these customers for customer due diligence and future monitoring purposes. That is how to discharge firms' AML, CFT responsibilities. To meet these challenges, firms will need to put in place effective and robust processes and controls. But on top of that, they need to have the right people and the right culture. Right people alone are not enough. We are all familiar with the saying that good people will become bad under a bad system. But getting the culture right, and as Andrew mentioned, getting the main culture and the subcultures right is not an easy task. And how to properly direct the staff is another question. And in the banking sector, we have seen is that getting the culture right, in some cases, may require a paradigm shift for some firms. The board of directors and senior management play a pivotal role in this respect. They need to set the right tone from top and ensure the tone cascade all the way down to the junior staff. And as Andrew mentioned, perhaps even the subcultures need to be aligned with the main culture to make sure that there is hopefully one single culture which permeates the whole firm. And ensuring firms have the right culture and a proper risk management, risk governance framework has been a key priority of the HMA after the global financial crisis. We assess on a continuous basis whether a bank has the right corporate culture throughout our supervisory processes, from off-site surveillance on-site examinations, prudential interviews with senior management, to most important of all, meetings with the board of directors. Our assessment is then reflected in the supervisory rating assigned to the banks, and also in terms of the liquidity and capital thresholds that we require the banks to observe. I talk about getting the right people. This is no easy task either. After the global financial crisis, we have seen increasing emphasis placed on compliance and risk management, and consequently, there has been a huge increase in the demand for experienced compliance and risk management professionals. I recall talking to the chief executive of 2 banks in Hong Kong, both being assessed by us to have deficiencies in their compliance functions. I asked them in separate occasions what the cause of the problem was. The chief executive of the first bank told me that the whole of the bank's compliance team quitted at the same time and joined another bank. The other said the bank had a turnover rate of 200% in its compliance department in 2014. And he was actually referring to the head and deputy head of compliance departments, which had to be filled twice during the year. So this clearly demonstrates how difficult these days to retain compliance and risk management talent, and senior management and board of directors must be able to create a suitable working environment for compliance and risk management professionals. They should demonstrate clearly that compliance and risk management have the board's full support, and this message must be passed on to all the staff from the front line, of defense, the first line of defense, to the second and the third. So this again goes back to what I've just said about the importance of maintaining the right corporate culture. James, perhaps I should stop here.
Yeah, Raymond, thanks. That was really good. And I'm just going to underline some of the points that you mentioned. And you mentioned overseas customers, and we've had some sessions today on the overseas and international nature of the Hong Kong capital market. And it strikes me from my conversations with big and small firms in all segments of the capital market, overseas customers, international customers are the future. That creates a number of risks that firms need to be aware of, and we at the SFC, and I know the HKMA, are acutely aware of it. I think the other point that you raise, and Stephen and I see this all too often, is the scarcity of expertise in compliance and AML in Hong Kong. And this is something that we just have to recognise as a risk for all of us, and to overcome the challenge. And I know there's some interesting work being done to promote compliance and regulatory affairs as an important stream of expertise moving forward. Finally, you mentioned the important role of the boards of the directors, and that's a really good segue into senior management responsibility, because as Andrew was outlining with the initiatives in the United Kingdom, it's a core focus area for regulators around the globe. I'd like to think of it, Andrew, as sort of not just responsibility, but accountability and ownership. Now that you've sort of outlined the complexity and some of the challenges of the UK regime, what are your observations on whether it's working or not?
Well, strictly speaking, it doesn't come into effect until next month, but it's certainly caused enough anxiety to already be starting to have an impact in those areas that I was describing. I think if I were a regulator sitting in Hong Kong, I would watch it for a little while and see how it plays out, and then steal the best bits. And the best bits are those simple points around job descriptions, or role responsibilities as they're called, keeping a map that pulls all of those together and puts the governance framework of the subsidiary in the context of the group, if that's appropriate. There's a lot of working through at the moment in the UK as to how all of that's done, and anecdotally at least, the UK regulators have sent a lot of the responsibility maps back as not good enough or opaque. So give it a little bit of time, but I think it will have an impact for a time on the way in which senior managers think about their own roles and responsibilities, how they set themselves up to succeed, what kind of management information they get, how targeted it is, and their focus on follow-through and delivery of their supervisory responsibilities. All the people I talk to are good supervisors in their own way, but all of them, I think, could do better, and they're being sharpened. Actually, the oddest thing about it all is that there's a lot of talk about the new rules that have been introduced that apply to senior managers. Only one of those is really new, and that's a personal responsibility to self-report. All the rest of them are almost indistinguishable from existing rules. But of course, there's a political and cultural change in the regulatory environment, an expectation that Mark Stewart, who some of you will remember with fond affection, will be taking more enforcement cases against senior managers. And so that's also focused the mind, and that is having an effect. Not always a positive effect, frankly, but it's having an effect on the way people think about and focus in on their own responsibilities.
But will it also, what are the potential unintended consequences of this, though? Is it, again, more work for lawyers?
No, actually, well, if Mark does his job, as I expect he will, that'll be great for lawyers. But there are some unintended consequences, actually, and one is right at the top of organizations, when you sit down and write out what you do, and you've got 300 words with which to do it in the context of the UK regime, you think to yourself, well, I better stop getting copied on all of those emails. That's not my territory. I want to protect myself from exposure under these rules. That will be a bad thing when it comes to dealing with the problem, the kind of response to the 1% that Stephen Poe was talking about, where you just have to get in and do it. You can't sit back and say, well, sorry, I can't do that until you change my formal delegation or my statement of responsibilities. The other thing that you're seeing is people who look at their 300 words and say, I need to know everything. They become micromanagers. So there's a little bit of dysfunction at the top that's starting to creep in. But I think there are mostly intended consequences and mostly consequences that are so far look like they'll be met.
Now, before I ask the regulators to respond, what I would like to ask Sophia is your observations, because you run a core function. Technology is the backbone and the future of financial services and financial services firms. What is your observation as to the level of interest, ownership, engagement by senior managers in what is essentially, as I said, the backbone of a firm and the financial markets?
Thanks. So I think over time, I mean, the panel talked about the importance of technology and how it's really changed the financial sector. But I think the change, cybersecurity is not new. But what's changed is that technology is changing the way we do everything in life now. So whether it's in your personal life, right, whether the way we look at our kids, how they talk to their friends, meet friends, learn from school, everything is on technology. The way governments conduct either their military or critical infrastructure such as power or telecommunications, or how business operates and financial sector is very driven by technology. So there's a lot of evolution in that. With that, there is more surface area to be attacked, basically. Right? Your data is probably in a lot more places. There are a lot of different vectors now that are being introduced that bad guys can attack. And I think for senior management, aside from the fact that generally, I'll speak in general terms, the more senior people may not have an understanding of technology and its complexity. Thus, it is even harder to understand the risk that you're carrying. And when we think about what's happened in, let's say, the last 2 years, you've seen large data breaches, let's say in the US, that has cost CEOs their jobs. You have seen in December a country whose power infrastructure was impacted by a cybersecurity event. I think we can appreciate that the magnitude of these risks are only increasing. The sophistication of the bad guys is something that should be a concern of everybody. But when you're running a company day to day, it's like this 1% risk that people are talking about. Is this something that you're aware of? Do you really think about what if on a really bad day, the bad day is not if, let's say, some data is lost. What if it becomes destructive, which is not a non-zero chance? What if you lose all your computer systems and your data, right? I think that's something that is a really serious topic for people to think about. So, and in the post-Snowden era, I would say the general public understands that the bad guys are not from the outside only, right? The threat of bad insiders is a serious one. And I think it forces people to really look at this problem differently, whether you have a small company or a big company.
And thanks, and we'll dive into a little bit more detail into some of those cyber challenges, but it's very interesting that you say that it's an enormous challenge for any individual, particularly a management of a company, a management of a licensed corporation or a bank to understand. But it's clearly a risk that he or she needs to understand. So I wanted to now ask sort of what is the mindset of the regulator, and Stephen, what might be useful is just to remind everybody that we actually do have a senior management regime here in Hong Kong.
Okay, good. Thanks, James. The first thing we want to assure the industry is that we don't have that sort of the complex senior manager regime that Andrew Proctor has just mentioned. In fact, also to set the record straight is our regime is pretty simple, easy to understand. All the general conduct obligations are set out in our code of conduct in the first 9 principles. And that 9 principles is very easy to read, not more than 2 pages. It tells you about your obligation on fairness, honesties, deal with the conflict of interest, act always in the best interest of the clients. And the 9th code of conduct sets out the responsibility of the senior manager. Let me read it out for you in case you don't have a copy.
It's not long, don't worry.
Basically, that principle number 9 says that the senior management of a firm should bear primary responsibility for ensuring the maintenance of appropriate standards of conduct and adherence to proper procedures by the firm. So that's simple. And further to that principle, general principle number 9, we do have some slight explanation about how to comply with that general principle. That is set out in paragraph 14.1 of the Code of Conduct. And that paragraph sets out 3 more detailed requirements. One is the senior management must understand the nature of the business that the firm is in. Second, senior management is responsible for managing the risk of the firm, including a periodic reassessment of the risk. And the third thing is senior management, like yourself, need to use your authority and your extent of responsibility. And in case of doubt, where appropriate, get the advice so that you will be able to discharge your function. So these are the simple hints and guidance provided in a code of conduct to help you to discharge your responsibilities as a senior management. As said before, all our requirements are simple, easy to understand, general, and these are some general guidance helping you to do some things that you find out is all common sense, nothing complex.
Well, Andrew Shung will be very pleased with that response. Just picking up on a couple of points that you said, Stephen, one thing to underline, of course, is that that paragraph 14 in General Principle 9 doesn't use the expression responsible officer. It uses the expression senior manager or manager responsible for the business. And that's an important distinction, and that's something to underline. Raymond, bringing you back into the conversation, you mentioned in your earlier remarks about the HKMA's focus on the boards, and this is something that we would also like to highlight in the SFC regulatory space, is that the boards of directors are responsible ultimately for the governance of the licensed corporation. They perform a very important governance, leadership, management role. And that's true whether you're a subsidiary of a global firm or whether you are a standalone, more Hong Kong-based entity. The boards of directors are important governance, risk management, and leadership functions and roles. But Raymond, can you tell us a little bit more about some of the focus areas of the HKMA in relation to speaking with the boards of directors and senior leaders, because clearly you've also identified that this is an important point of entry for good regulatory outcomes.
Yes, sure. Thanks, James. I think one, as I mentioned, ensuring that the board of directors play a pivotal role in maintaining the right corporate culture is a key priority for us. And what we have been doing, and I would like to echo one of the points mentioned by our earlier speakers, that we attach a lot of importance to the role of INEDs on the board. we basically require that 1/3 of the board to be INEDs, and we have been doing a lot of work to empower the INEDs to make sure that they perform their function properly. And as part of our supervisory work, we will have meetings with the board of directors. From discussion, we will make an assessment whether the board attaches sufficient importance to risk governance. From my personal experience, I actually had a meeting with the board of directors of a major bank here in Hong Kong, and one of the INED, who is new to the board and who is has newly become a director of a bank board. He kept on asking me questions about why the regulatory requirement of the HMA has been so tight, why our AML CFD requirements have been so stringent that no people can now open account with banks, particularly those people like him, who is a politically exposed person. Well, at the HMA, we don't mind, handling difficult questions like this, but the message that I got out of this meeting with the board is that, at least for this director, he's not attaching sufficient importance to risk governance, because he was trying to complain about our regulatory requirements without due regard to what the requirements are aimed to achieve. So I later on talked to the senior management of the bank and asked the bank to see if greater support can be provided by the senior management to these directors. And at the HMA, some of my colleagues from the banking conduct departments are here today. We are working on a project to trying to empower the INEDs to ask more questions about how the firm is actually managing their risk. And last year, our chief executive, Mr. Raymond Chan, led a delegation to go to Beijing, and we jointly organized a training session together with the CBRC for the INEDs. And this year, we are going to run a similar training session for other INEDs who didn't have the opportunity to attend the last training session. And hopefully through this training, we can provide more empowerment to those INEDs so that they can perform better functions in looking after the interests of minority shareholders and also the interests of the general public in terms of banking stability and the safety and soundness of the institutions.
Raymond, that's really interesting, and it's obviously a tie back to what Prue Bennett was talking about in the last panel, and I actually think that some of the governance issues when it comes to listed corporations can easily be translated across, as you've just articulated, into the realms of financial services firms. But I did want to now return to cyber risk, and Sophia's already outlined some of the enormity of the challenge, but just one last question on the enormity of the challenge before a couple of technical questions for you. I mean, how many cyber attacks does a large financial institution sort of receive every day? Can you give some numbers around that?
Yeah. Well, I'll be very careful to talk about number of attacks per se, but if you look at how many things a large corporation may block from getting inside their perimeter, and that's just one aspect of it, it would be in the millions, right? Like I said, the surface area for anyone with some amount of technology may be large, so you're really blocking a lot of activities from the outside. But when we look at this challenge, I would say it's somewhat simplistic to just look at that type of stat because it could be misleading. When you look at the whole ecosystem of, let's say, wire transfer or whatever it is, let's say we take down something like 50 phishing sites a day that may impact our customers. So I think when you look at this complex issue of where the attack vector is, it's not just about blocking things from the outside, which there is decent technology to do. It's about also looking at everything going on inside and in the ecosystem with your client.
Yeah, well, that's exactly right. And one important point to underline is that in our view and our observation, and unfortunately our experience, it's not just a problem for large financial institutions, it's a problem for every financial institution and every consumer and every customer, because we're all using devices more, and as you sort of said, we're susceptible internally and externally to these risks, and I think that's a really important point to underline.
If you don't mind, I would
Yeah,
also
please.
add that, I would be concerned. I mean, I think the larger companies, and especially, let's say, U.S. firms, because I think we've been at this for over a decade or 15, 18 years, smaller firms really do not have the investment powers to protect themselves, and that, should be a general concern. So I think the challenge is kind of magnified by that.
Yeah, but you actually raise a really important point, because that's the extra challenge for firms with less scale than, let's say, yours. And this is why there needs to be an important amount of thinking by industry associations, policymakers, regulators, and individual firms themselves on that. And so you raise a really important challenge. But just, yes,
Let's pick up
please.
on one aspect of that, which I think is important, and that is the capacity of those smaller firms to understand the risk horizon that's out there. It's very patchy if you look around the world at the way different, not just regulators, but government agencies are sharing information and making that information available. It needs to be better coordinated, I think. At the moment, the approach that regulators have taken, notwithstanding that it's a decade or more that the bigger banks have been looking at it, the approach that regulators have taken is effectively to ask people to reflect. Surveys have gone out, with some guidance, of course, in the context of ISO standards, etc., but without really articulating an expectation of the standard to be met. And it's very tough to do that in the context that we've just heard described, where you are going to be attacked and you are going to be breached. The standard hasn't been there, but helping them to better understand the threat horizon is, I think, a really important thing, especially for those smaller firms that you described.
Absolutely, and I think that cuts across another issue that I hope we'll get to, Andrew, which is just coordination globally on some of the supervisory and risk challenges. And I think cyber is perhaps one area that will have a catalytic effect to bring industry, policymakers, governments and regulators sort of together. But Sophia, I want to just drill in a couple of things, because the other thing about this topic is that there's lots and lots and lots of jargon. We talk about contingency, we talk about preparedness, we talk about cyber resilience and best practices, but what does that all mean? And can you, in a couple of minutes, just sort of help us out?
Right. So I think if you're, probably if you have kids, maybe you want to put them in IT security, because just like compliance, it's a really hot area. But I mean, cybersecurity is about risk management. I think there are definitely actions that all companies should take. On the whole, I would say Asia Pacific the issue is compounded because of the use of pirated software. Things like software, creates vulnerabilities. If you're using pirated software, I think it's another double whammy for institutions doing that. So getting basic hygiene around cybersecurity, updating your software, blah, 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 that stuff is important. Knowing where your important data is, protecting your crown jewels, I think that is important. We've realized that email is the easiest ways bad guys get into your company. And let's say our firm has taken a very strict view, and this is where the senior management support comes in, because some of the controls, unfortunately, that we have to put into an institution will be restrictive, right? And I've been in investment banking all my life. Bankers just want to do business. They don't want to click on a different thing to do this to secure their information. But without senior management support, some of those controls that are helping protect users as your weakest link will not be possible. So things like training people, making sure they know not to click on things, and things like that. But beyond that, right, you can do things like independent assessment just to make sure where your firm is. We actually have our own internal specialists that attack ourselves to make sure we understand where we are as well. Last but not least, well, two more things. The government industry sharing thing. If you look at where the West has been for a while, it's been progressing quite actively. I think the region is moving in different speeds. That is very important for both the private government and public sectors to coordinate around these actors. Lastly, this whole thing about cyber resilience, I think you can almost assume that things are going to happen. In fact, I think some companies just don't know the bad guys are inside because they may be inside for a long time. And it's making sure that you can bounce back from these events. So when something happens, how do you continue to run your business? How do you provide continuity? How do you recover? I think that's an area that a lot of companies should also move towards.
Yeah, continuity and contingency are the two key words that at least I take away from the response, because it's almost a matter of, unfortunately, it's not a matter of if, it's a matter of when. Stephen, can I ask for your observations, both from your important leadership role at the regulator here, but also as chairman of the IOSCO Supervisory Committee that has been looking at some of the cyber risks on a global regulatory perspective?
Okay, thanks, James. As mentioned by all the panelists, cyber risk is definitely some things that are affecting us. In fact, we saw it happen in overseas exchanges. There's an attack on the exchange. And also we saw examples of, for example, some hackers use a trade on shares based on some hacked news release information. So IOSCOs, which stand for the International Organizations of Securities Commission, which is a international bodies of all the regulators around the world, look at it. A task force has been set up, look at the issues from different angles. For example, from the issuers' angles, from market infrastructure issue, and also from the market intermediaries issues. As mentioned by James, being the chair of one of the committee, I'm basically responsible for the part on the market intermediaries. So quite happy to share with you some of the latest thought and work done by the IOSCOs on these areas. In general, they look at it and identify 5 areas that all firms and regulators should pay particular attention on, which in fact has already mentioned by Sophia earlier on. There are 5 areas covered. One is identification. The firm should have a management structures in place to identify the issues of the cyber risk. Second is on the protection. Firms should have the right systems in place to guard against the attack, for example, also of the antivirus program. And third, detection. Firms should have the program in place to detect any unusual symptoms. For example, very high volume activities in some areas, or maybe some sort of the access from a very remote IP address. Fourth, response. How the firm should respond when they are being attacked. That including about your reactivation of your backup site. And finally, the recovery, your BCP. So let me sum it again. The 5 key areas would be the identification, protection, detection, response, and recovery. So these are the 5 areas that we expect all the market intermediaries to put in place to guard against about any potential attack on the cyber area. And this on the work done on the international front. Back at home in Hong Kong, SFC also placed a lot of emphasis on the potential threat on our securities market of all these cyber risks. And very honestly, I must admit, at least for me, I'm not an expert in these areas. So we engaged a firm of consultants to help us to look at these areas. And what we did in last year is that we picked up a few firms. We went in, really talked to their management, really talked to their IT people, risk control people, to understand about the operation of their cyber risk protection systems. In addition to that, we also picked a number of representative sample of firms. I think it's more than 10 firms. Some are big ones, some are smaller sizes, some are buy size, some are from a sell size. That we also talk to the management and the IT people to get a better understanding about their awareness on their concerns. The work has more or less been complete, and very honestly, before me, I got a very long list of the issues that the SFC need to share with the industry. And we intend to do some sort of the sharing sections in the near futures to let you know about the issues. And in particular, as Andrew Proctor mentions, our intention is to share with you not only the deficiencies, but also the good practices that we have identified, how other firms are doing this job so that you can help yourself in improving your systems to catch up. But even without going into the details of the issues, I can't stop on pointing out one or two very general points. I won't go into the acronyms. I learned a lot of acronyms, like DDoS, all these things. I don't want to repeat it. But let me just repeat a few key messages. One is cyber risk is not something just left it to the IT people. We do expect this is something that, starting from the senior management to business peoples, to control functions, to the risk peoples, and of course, IT get involved. So I would strongly recommend when you go back home, spread this knowledge. Cyber risk is really something that we need to deal with, and that to be dealt with by the firm, by all team peoples, not just by the IT people. And second, if you are working in a global firm, have to spread the message to your head office, because in some instances, when we talk to them, they told us that this global bank did conduct drills, they did look at the stress testings on these potential crisis scenarios. But these things were done at the head office levels, probably at New York. And the local firm, means the Hong Kong firm, have not been involved in all these drill testings. In order to make the whole thing more meaningful, get your local people involved so that when something really happens locally, your local management can react. We do recommend that the local management and the local people should be involved in this global exercise. So these are the general messages on the cyber risk. And in particular, when we look at our local industry here, we found that quite a number of the firms in Hong Kong have actually been hacked, and some unusual things happened in our industry. So back to the end of January this year, just a few days before the Chinese New Year, we issued a circular, I hope you remember. We called the tips on safeguarding of the transactions on your online trading platforms. Because we did look at something hanky-panky working on. So we gave some tips to the industries. Let me just summarize that 3 tips again here. One is firm need to monitor any unusual activities going on your client account. On this, I don't mean just look at those IT side, look at like very unusual activities on your systems, but also look at any unusual transfer of funds by your client or any unusual transactions by a client. If the client has never dealt with 3rd tier, 4th tier shares, why suddenly that client use all his or her money to buy these 3rd or 4th tier stocks? This should ring the bell. Your people should follow up with the customers to understand whether the account has been hacked, so that these transactions are not the genuine customer transaction. And in relation to that, of course, we do recommend the industry to put in place the appropriate antivirus systems. And finally, strengthen your password controls. As recommended by the police, try to use 2 levels password, and probably it's better that 1 level would be a one-off generated by the systems. And as a sum up of what I said, I'm quite sure you will forget most of what I said, but do remember, this is my final, very important guidance response. In case if you ask your client to reset the password because of whatever reason, don't let your client to reset the old password, because this is the tendency when the client got the notice from you, reset it, they are so furious, so nuisance that they just use the old password. And think about it, when the hacker hack the systems, they will hack the weakest link. And generally, the investors would be the weakest link. In case if you allow your customers to use the old password, you are basically giving the second chance for the hacker to hack through the clients and go into your systems. So there's a lot of the lessons we have learned, and we have issued the circular giving the guidance as what Andrew mentioned about. We tell you about what are the issues, the problems, give you some tips. And in the coming times, we will also share with you also the good practice we have learned, hopefully help you to guard against the real threat, the cyber risk.
Stephen, thanks. That was really,
James.
really good summary. And I just underline the education of customers. Yes, Andrew.
Just one observation about that. I think even if you did all that Stephen described, and of course that's what you should try to do, for the reasons that Sophia has given, you'll still fail at some point. Someone will get in. And I think the regulator has a really important role to play in terms of the reaction and response of the industry here, because my observation has been that when there is a problem internally, it's very hard to work out sometimes what has happened. Who's behind it? Internal, external. What's the motivation? How far have they got? Do they have information? And it's often difficult, actually, for the IT department to give it up to the compliance department or legal to make a report. If the regulators react in the right way and recognize that difficulty, then I think you start a virtuous circle. It would be a bad thing, in my view, for the regulators to come thundering in and say, why didn't you tell us about this yesterday? This is not an area where all the other concerns about timely self-reporting are recognized and respected, but this is not an area really to make that point in those kind of fine judgments, because they're really difficult judgments, I think.
Yeah, so Andrew, I think we do need to open up the dialogue on this, and that's one of the clear takeaways of this session. Before we run out of time, I did want to get Raymond's perspective on cyber risks and technology risks from the HKMA perspective.
Thanks, James. I would like to pick up a point mentioned by Sophia and Andrew that the smaller firms are relatively less prepared in terms of handling cyber risks. What we have done something very similar to what Stephen has mentioned. We have issued guidelines, doing on-site examinations. We have done other supervisory reviews to make sure that firms are paying enough attention to cyber attacks. But I just want to mention that we also supported a crisis management drill organized by the industry last October. And that drill actually involved scenarios such as cyber attack of an important internet infrastructure in Hong Kong, hostage of a major technology service provider by an anti-capitalist group, and leakage of data related to financial firms. So these type of scenarios are rather severe and will help the industry prepare for real-life situation. And I will also mention some of the initiatives that colleagues in the HMA have been doing, which is to work with the banking industry to develop a comprehensive cybersecurity program comprising a cyber threat intelligence sharing platform, a risk assessment model to assist banks to assess the robustness of their cyber risk management framework, and a training and certification scheme to raise the level of competence within the industry. I think the point about an intelligence sharing platform, I hope will go some way in addressing Andrew's point about the government, the regulator is not doing enough in relation to intelligence sharing.
They're important initiatives, and another an important area where there's again a lot of global and Hong Kong coordination is on anti-money laundering initiatives, and this is another theme that we wanted to, in the last 5 or so minutes, sort of speak about. Before we do, Andrew, I wanted to get your observations on some of the global developments. There's a lot of intensive focus by prosecutors, regulators, policymakers on anti-money laundering, and I'd like you to paint the picture if you could.
Wow, that is a big question. I think, let me come at it from a slightly different angle, and that is there'll be people in this room who are already being hounded by their front office to get into Iran and to start to exploit the potential of that country as it opens up to the world. And there are lots of good and positive things about that. My guess is that the same mistakes will be made in Iran as were made in Libya before that. People will go charging in and they'll use introducers and they'll be desperate to get the first opportunity to develop business, etc. And they'll make the same mistakes and they will overlook the detail and the importance of getting it right in terms of whether it's a politically exposed person, to take the example we heard this morning, or just the basic controls. My sense is that banks have been punished so much over sanctions and embargoes and AML, particularly by the United States regulators, that they have started to understand that, frankly, on a cost-benefit basis, it's just not worth it. But that there are still weaknesses and temptations that will arise where the front office is willing to do the business and do the trade and to overlook those niceties. And so we're not there yet culturally. We're not there yet in terms of the controls, despite the billions, I suppose. No, that's probably an exaggeration. Certainly hundreds of millions that have been spent on systems and controls around patterns of trading, etc. The breakdowns still take place in the simple human things around client opening and client adoption.
That's right. And just when it comes to good old-fashioned client opening and client adoption, again, it's not just a big bang problem. It's every organisation that faces a customer, which is most, if not all, has this challenge. And so, Stephen, could you outline some of our focus areas in the Commission in Hong Kong when it comes to our important focus on AML?
Yeah. SFC has a three-point approach in relation to the addressing of the AML issues. I'll be very quick because I understand we want to go for lunch. The first one is that we did a survey in last year's to understand about the AML controls and vulnerabilities in our securities sectors. And based on the results of the analysis, we have picked up some firms for detailed review. And thirdly, we have provided also of the guidance and trainings to the industries. For example, there is a self-examination checklist on our website. So please, if you are not familiar with the AML controls or requirements, please use this checklist as a self-reference. And let me just concentrate on our film inspection findings, which I hope you'll find more interesting, relevant to you. 3 key messages. First one, on the senior management oversight, we found that basically all firms, no matter it's big firm or small firms, are fully familiar with the AML requirements, and they have been putting a lot of focus on that. So this is a big tick. Second, customer due diligence, customer onboarding. That Raymond just mentioned about the complaints, the difficulty of opening accounts. But in general, we found that the industry really take a look about the requirement and have done a lot of the work on these issues. So it's not a major concern for us. But the third point, which I would like you to take a look about, the third point is about the identification and reporting of the suspicious transactions. We do have concerns. When we look at the firms, we found that there are instances that all these suspicious activities have not been detected and reported, despite there is a lot of the very obvious red flags. Let me just share with you a few of these. For example, if there's a lot of the transfer of the fund to and from third parties, this should ring the bell. Or in case if the customers, when they open an account, say that he or she is the housewife, but there's millions of the transactions, no matter it's buy-sell transaction, go through every day, should ring the bell. And the third point, more importantly, is about the reporting thresholds. Assuming if the firm set a reporting threshold of 5 million, everything above 5 million need to be reported. Then in one instance, we found there was a lot of 4.9 million transactions going just below it and never get reported. So let me tell you, being a regulator, by seeing it, I will regard it this as an open invitation for the regulator to spend more time to dig in, to understand why there's a lot of all these transactions just below the threshold. Never get caught, never get reported, never get brought up. So I hope this is a very short message for the industry.
It's a good message. And Raymond, what's your message from the HKMA?
Well, I think AML CFT, I just want to mention that we in the past have, over the last couple of years, I have been mentioning double our resources, but actually it has more than doubled these days. So we have placed a lot of emphasis on that, and we expect the banks to do the same. AML CFT compliance is the first item on the agenda when we meet with the board of directors, and we are seeing a lot of improvement being made by the banking sector, but we don't think that that's enough. What we see the major issue here is in terms of customer due diligence, the banks are doing reasonably okay, but the problem lies more in terms in relation to ongoing monitoring and updating the risk profile of the customers. And also, and that information is very, very much important to help the banks ascertain whether a particular transaction is really suspicious or not. Because without sufficient information about the change in the risk profile of the customers, we will not be in a position to determine whether a transaction is suspicious or not. So I think more needs to be done, and we at HMA has been trying very hard to make sure that banks make the sufficient investment in terms of AML CFT compliance. May I also take some time to mention about the de-risking, which is a trend we are observing in the banking industry. We have seen banks trying to avoid the AML CFT risk with some particular customers who are assessed to be of higher risk. We don't think that is a proper approach, and we have been asking the banks, providing guidance to them in terms of adopting a risk-based approach to managing the AML CFT risk, rather than trying to avoid or totally eliminate those risks, which is not a proper response to manage the bank's business.
That's a really important point. Tick-box approaches will not work. Thank you very much to our panel. We're out of time. We've discussed a lot.